Hello, welcome to our Facebook Live Super Fundamentals for Estate Planning Part 1. So it is the 14th of March 2024. I am your presenter today, Tara Lucke, founder of The Art of Estate Planning. Now, before we get into this, I just want to acknowledge that today I'm hosting this training from the lands of the Tarabulung Bunda people. And I also want to acknowledge the traditional custodians of the lands on which each of you are living, learning, and working from today. I want to pay my respects to elders past, present, and emerging, and celebrate the diversity of Aboriginal and Torres Strait Islanders peoples and their ongoing cultures and connections to the lands and waters of Australia. So if you are just tuning in, I'm Tara Lucke, today's presenter and founder of The Art of Estate Planning. Thank you for joining me. And our topic today is called Super Fundamentals for Estate Planning, Part 1. Now, this is actually part of a 3-part series of presentations that we have coming up around super and estate planning. So it's a big topic. Today is part 1. Next month, we have David Lunn, financial advisor, coming to talk to us about estate planning for illiquid assets in SMSF, so those big bulky assets. And then in June, I will be coming back for part 2 to wrap up super fundamentals. So today's topic is really about getting everybody to a similar standard of understanding around the super regime and how that will inform our estate planning decisions. So particularly for the lawyers, today is designed for, and I'll just put my hand up for those who don't know me, I am a lawyer. So I am trying to do my best here to be a translator and get all of the super information into a really easy to understand sort of methodology for the lawyers who have not had a lot of experience with the super regime. So I know that we have financial advisors and accountants in this group who are experts in this field. No pressure. But I know we also have a lot of lawyers who might be doing estate planning but don't have a really deep background in superannuation, particularly if you come from a field like family law or something adjacent to estate planning without that pure technical tax background. You might be a little bit overwhelmed by the super regime, which is perfectly understandable and fine. So this is designed for the lawyers who I want to just bring everybody up to speed so that in part 2 in June, we can really dive into estate planning strategy with superannuation. Okay, so there's a lot to cover, but there's a lot we're not going to cover. And this just really gives you an idea of the depth of this topic, right? These are the things that we will not be covering in specie distributions. No worries, because David has us covered next month. Same with real property, liquidity, all of that. There's a huge list here of things that we're not even touching on today. We are just going to really start with some of the core principles. Please feel free to comment in the comments. We'll be keeping an eye on that and make this interactive. And yeah, if you do have any questions or things you want me to explain or things you want me to pull me up on, just put it in there and I'll keep an eye on that. But let's dive in. And first things first, in the super industry, there's 2 main super funds that you or your clients will be involved in, right? On the left, we've got the public offer or industry funds. Those are regulated by APRA. And in a big fund like that, the members are not related or connected to each other typically, and they have no relationship with the trustee. It's an arm's length public trustee, and they are just one of many, many members. On the right-hand side, we've got our SMSF. Now, that stands for Self-Managed Superannuation Fund, and that is a closely held super fund. So the members do have to control it and be part of that, and they're typically related to each other as well. So we're going to sort of touch mostly on the SMSF context, but a lot of the things we're talking about today are relevant for all funds. So for SMSFs, a very quick, like 101, you can only have 6 members maximum. It's governed by what we call the SIS Act and the SIS regulations, so its own specific legislation. It's important to note that super funds and particularly SMSFs at their core are still a trust. So, we'll look at some of the reasons behind this. I've got a good example coming up, but still always have in the back of your mind, this is still a trust environment. And that is, we've got things like trustee duties, a lot of the cases around trustee discretion, which apply to family discretionary trusts, have a relevance for SMSFs as well. So we're still dealing in that trust regime. One thing to keep in the back of your mind is that the SMSF must satisfy the sole purpose test. So there's a lot of restrictions about what the trustee of an SMSF can do with their money, what they can invest in, getting money in and out, and all sort of roads point to the actions have to align with the sole purpose of providing retirement benefits for the members. So be mindful that the flexibility that you might see with a family trust, we don't have that with an SMSF. It's a lot more restrictive, and we have to bear the sole purpose test in mind. Now, it's not as relevant for estate planning, right? Because we're kind of talking about death and that type of event, but it is still important to bear in mind. The other thing is, especially for the lawyers, is that there will always be someone with a financial services license connected to and advising the SMSF. Okay, so that's like a financial advisor or maybe an accountant with a limited license. So you do not have to know everything about the SMSF, and there will always be advisors who know this SMSF and the strategies for the members in there intimately that you can lean on, and you really should. One of the things I'll emphasize today is collaborate with the financial advisor or the accountant advising the clients about the fund. There is a really fine line when we're looking at estate planning for super between what is legal advice and what is financial advice, and you really do have to collaborate. So I know I say that all the time, collaborate, but this is an area where it is more important than ever. Another thing, just to sort of emphasize the very strict regime that goes with an SMSF, is that it gets audited annually to make sure it isn't breaching the sole purpose test and it's not falling out of compliance with the SIS Act. There's really serious consequences for an SMSF to be non-complying. So ASIC can, for example, require it to restructure or wind up the fund, and also the lovely concessional tax benefits are voided, and you'll find penalty tax rates attaching to the income and assets and that type of thing. So it's really important that we as lawyers don't do anything to jeopardize the sole purpose test. It's very rare that anything you would do in an estate planning context is, but if you're trying to be creative and dreaming up different strategies and things, always have that in the back of your mind. Because if it's set up in a particular way, there's probably a reason why. Okay, speaking of that, you'll nearly always see a very common ownership structure when it comes to who is the members and controllers of an SMSF. So the SIS Act in Section 17A actually requires that if you have a super fund with 2 or more members, then each member of the fund must be either an individual trustee of the fund, or they must be a director of the corporate trustee. So you can see here, the members are our people in pink. On the left, we have a self-managed super fund with individual trustees, and on the right we have a self-managed super fund with corporate trustees. So on the left with the individual trustees, you'll see we have to have a correlation between the members and the trustees. And on the right with the corporate trustee, again, the directors have to basically match up with the members. The shareholders are less relevant. It's really the directors. Now, there are exemptions to this, and issues like, it's not always like that. There are exemptions if, for instance, someone loses capacity and we're bringing in LPRs, but this is like the foundation starting point. when we're dealing with a sole member fund, then the member is either the only director of the corporate trustee or only one of two directors or corporate or trustees. So again, we have to have the member being a trustee or a sole director of the corporate trustee. And I said before, SMSFs are trusts. The reason, particularly on the individual trustee side of things, that we have to have this extra person here is my pen going to work? Let's see. It's not going to work. That's all right. Is that we have a trust. If we only had the trustee and the member is has a fixed entitlement in the trust, then we wouldn't actually satisfy that fundamental definition of a trust where we have a separation between control and the right to benefit, because control and benefit would be sitting with that same person. So we need this Navy trustee in there so that we actually can separate. So, back to Trusts 101, still applying even though we've got these SIS Act rules as well. What I'm going to talk about mostly for today is tax and super. Okay, so if you're sitting here going, oh, I'm just going to log off because I don't give tax advice, I am not trying to upskill you to give tax advice on super funds today. Please do not start thinking that a quick session on this will authorize you to do that. But I'm trying to give you an idea around the whole tax regime attaching to super, and particularly just the death benefit payments, because this actually can really inform a lot of our estate planning strategy. So some examples of how understanding the tax treatment of death benefits and money going in and out of the fund can be relevant to your estate planning strategy is, firstly, if we want to allocate super to people who can receive a better tax rate on the super money versus people who will pay a high amount of tax on it, because some people can receive it tax-free, others pay tax on it. So knowing that is important, particularly in a blended family context, maximizing an asset pool and making sure we're not exposing estate assets or available assets to unnecessary tax can really help. With blended families, the more money, usually the better, to be able to make sure everyone is provided for. Please make sure that you do work collaboratively with the financial advisor. I just can't emphasize this enough. Another area particularly is around the timing. So for instance, if we do have terminally ill or incapacitated clients who satisfy a condition of release, maybe we could be looking at a death benefit withdrawal, one of those deathbed withdrawals, or some other way to make sure that we're maximizing the tax planning opportunities. And then there's also things that we can do in a proactive sense, like a withdrawal and recontribution strategy. I'll just make a note in case I forget later. We had an excellent presentation from Delene Jacovides on the withdrawal and recontribution strategy that you can go and watch. We've got a whole hour on that. It's really worthwhile, and it would be a lovely follow-up to today as well. So let's start talking about the tax treatment for super monies. And in particularly, we're going to start with the very beginning about how to get money into the fund. So if you have ever looked into this and you've seen these phrases, taxable tax, taxable untaxed, like when I first learned about this, this is pretty much the face I was pulling, because it's confusing, but I'm here to try to simplify it for you. And what I would actually like you to do is put yourself into the shoes of our client here. So I'm going to talk about this as if this was me, because you know what? We are all members of super funds, and this is relevant for all of us as well. Okay. So there's two main ways that you can get your money into your super fund. Okay. The first is what we call a concessional contribution. So this is using your before tax income to put it into the fund. So if you are an employee and you are getting the super guarantee payment, that you don't even see it, it just comes out of your salary, right? And your employer puts it into the fund, that's going to be a concessional contribution. If you are like a business owner, self-employed, or a contractor, then this might be money that you put in either, when it's tax planning time or just yourself as you go. And the main thing to think about is that we're claiming a tax deduction, okay? So a concessional contribution is putting money into the super fund where you claim a tax deduction on it. So that money is basically taxed at 15% in the fund instead of being taxed at your marginal rate. So just to note, there's usually a limit on this. I've said 25,000. As of this year, the limit was 27,500, but it is usually indexed. So from 1 July 2024, it's going up to 30,000. So the basically, as you can see here, we've got the next type, which is in blue, the non-concessional contribution. So this is your after-tax money. So let's say I've got $15,000 in my savings account. So I've earned that money, I've paid tax on it in my tax return, and I'm saving that up in my savings account for a rainy day. And I decide that actually I want to put that money into my super fund is what I'm going to do with that. So I've paid tax on it. It's my clean money, right? Like the ATO and I are good. We've sorted each other out. That's my money. So I'm putting that into my self-managed super fund. I don't claim a tax deduction on putting that money into my super fund. It's just kind of like savings, right? So that's what we call the non-concessional contribution. And I've just made a note that is indexed as well. So the cap is currently 110,000, and as of 1 July, it's going up to 120,000. So what then happens is for every super fund, I'm using an SMSF here, but it's the same if you've got a public offer or like industry super fund. Every member has their own little account where they keep track of how much money has been contributed, the earnings and the capital growth on investing that money, and then what the nature of it. So whether it is a taxable taxed component or a tax-free component. So if it is a concessional contribution where you haven't paid tax on that money yet and you put it into your super fund, it becomes the taxable tax component. If it's the non-concessional contribution where you've paid tax on that money and then you put it in, it is your tax-free component. So I've tried to keep blue, black, if that makes sense. So there's actually 3 types of components that they record and attach a tax treatment to. So as I said, we've got that tax-free, which is that blue non-concessional super contribution. You didn't pay claim a tax deduction when you put that money into the fund because you already paid tax on it. The taxable taxed is the concessional super contributions. The fund pays 15% tax on that income that it earns on investing that money while it's in the fund. Now, when the money comes out, there's a 15% or a 17% tax rate. So there's a 2% difference depending on whether the Medicare levy applies or doesn't apply, which I'll mention when that happens in a moment. Lastly, we have the taxable untaxed component. I mean, who came up with these names? They're not really helping us. Anyway, 30% or 32% is the tax rate that applies on those funds. And this is a little bit tricky, to be honest. Usually it can be either super death benefits from like an untaxed super fund where the fund has not paid any tax on contributions or earnings. Now, if we do have any financial advisors or accountants watching and you've got a really good example of a type of fund where the benefits would have that characteristic, please let me know. I mean, my understanding is usually like maybe a government run, like public sector super scheme, but it's not something I'm super familiar with. So I would love to learn a bit more about it. The other thing, which is probably more common, is like life insurance proceeds, where a member has died, the policy was owned by the super fund, and the super fund claimed a tax deduction for the insurance premiums, and the member died under 65 years. And the proceeds were paid as a lump sum. So we will have an example to show that through. But usually we're dealing with one of these two on the left, but sometimes some life insurance proceeds can be that taxable untaxed component. So I'll show you why that's relevant in a little moment. Just to keep going with our timeline though. So we've talked about tax payable when it goes into the fund. Now, what happens for the money that you've contributed into the fund while it stays in the fund? So you can put your super fund into pension phase, usually when you have hit 65 years of age. I think that age actually changes. Financial advisors will be able to tell me. Or if you've met a condition of release without a cashing restriction. So most of us watching, you're probably watching this at work, so you're not retired. So your fund will be in accumulation phase, right? And so the income is just taxed at 15% in the fund, which is very nice. The whole idea of the super regime is to motivate people to provide for their own retirement, and the government gives us these tax concessions on the income so that we are motivated to put more money into our super funds, right? And you probably know this, but just to be clear, super funds are probably the largest investors in Australia on the stock exchange. They are all our contributions are invested on our behalf as members to earn money to help grow our nest egg so it's bigger and bigger, and we get the benefit of compounding interest and returns and all of that by the time we hit that retirement age. So nice 15% tax rate, usually lower than what our tax rate would be on our income outside of super. For the money that's in a pension phase, you don't pay, it's tax-free. So that's really nice, particularly if you get those franking credits as well. So once you're in retirement phase, you're not paying any more tax. So it's obviously way more complex like that, particularly if you're transitioning to retirement, but just, it's the most simplest of how the regime works. I do want to mention this transfer balance cap, which applies to members who might have their super in pension phase. So it was introduced back in 2017, but so time has moved on. It's here to stay, but it still is possibly quite new to some people. So again, we have a limit here on how much each individual member can hold in their super fund in pension phase. So it used to just be however much money you had in super, when you hit that pension time, the whole thing could be put into pension phase and earn no tax on the income earned. Now they put a cap in. So the cap is currently 1.9 million. As I understand it, it is not increasing on 1 July. So in case you haven't worked it out, this is probably something more relevant for your high net wealth clients, because they need to have, over 1.9 million in their super fund. So what happens is, if you have more than the 1.9 million in your super fund and you want it to be in pension phase, you either have to pull the excess out of the super fund environment or roll that amount back to your accumulation account balance, and then you start paying that 15% tax on any income that amount earns. Or if you keep it in the pension phase over the 1.9 million, then there is a transfer balance tax. So there's this good companion ruling here. If you want to learn up more about it, you could do like a whole 1 hour presentation on just that topic. So this is just to get it on your radar. Work with a financial advisor. Clients, especially if you're a lawyer, clients will not be coming to you saying, help me solve my transfer balance cap issue, right? They will already have an advisor who is alert to this and have a strategy in place. But the reason I'm mentioning it to you is because there is an estate planning consequence, particularly if you've got two clients who do have like high pension balances and one of them dies. So as we will talk about this in part 2, but when a member dies, there is like a compulsory cashing, or that like they have to do something with their super balance within about 6 months of them dying. So typically the options would be, if we pick on Sue here, her $1.5 million in super in a pension account. If she dies, she can just have that come out of the super fund. It leaves the super environment, and assuming she wants to leave everything to her spouse, John just takes that in his own name outside of super. But now he's got $1.5 million. He might have to invest it. He's going to start paying tax on any earnings. So a lot of people want to keep, when they've got a spouse, they want to keep their super in the super fund environment because of the 15% tax on accumulation, or the tax-free amounts on the pension. So back in the old days, Sue's 1.5 million would just go to John, and I'm just frustrated my pen's not working, and he would get his he would have 3 million, right, in pension phase. No worries. Now he can't have more than $1.9 million in pension phase. So even if Sue had a reversionary pension, or if we are recommending a strategy, we have to be cognizant of this $1.9 million limit. And there's things John can do, like he could take Sue's 1.5 million as a death benefit pension and roll back 1.1 million of his current pension and leave his 400 to like make him up to the 1.9 limit. There's things he can do. It's not like a disaster, but a financial advisor will need to be involved to make sure they're not going to be copped with that excess penalty tax, and that everything is compliant. Okay, so just bear this in mind if you have got high net wealth clients who are coming to you with high member balances. Another reason to work collaboratively with the financial advisors. Okay, this is what we're all here for, getting money out of the fund. And I'm really just going to focus on death events. Okay, so in a death context, because you can get money out of the fund earlier if you satisfy a condition of release, but we're not going to dive into that because that's a big topic as well. So firstly, there's actually limits on who can even receive the super money from a super fund. So it's not just open slather. You can pay it to whoever you like a will. You can actually only have the super monies going to people who satisfy this definition of super death benefit dependents. So the regulation here, I'm going to give you quite a few statutory and regulation references for you to then go off and, have a look at those in your own time. We're not going to read those together because we got a fast-paced topic here. But so if you want to go and look at those rules, have a look at regulation 6.22 of the SIS regulations. So it can go to super death benefit dependents or the legal personal representative. So what that means when we say the legal personal representative means the executor or administrator of the member's estate to be distributed under the will. So if there's no super death benefits or a legal personal representative, then as a last resort, the fund can decide to allocate the member benefits following like general trust law principles. And of course, just bearing in mind those principles about trust, it's a trust. We have to follow the trust deed. Every single trust, we have to comply with the trust deed as well. So this is the legislative regime. And then perhaps the self-managed super fund might have narrower rules, but nearly always they mirror this requirement from the regulations. So let's have a look at who are death benefit dependents. On the left here, these are the people who are allowed to be nominated. So spouses, current spouses, including de factos, children, a financial dependent, a person who's in an interdependent relationship, and then the legal personal representative. So when you are reviewing an estate plan for a client and they come to you, it is so essential to check their binding nominations that they might have in place. And it really grinds my gears that this is so complex, because like, let's think, people make their BDBNs when they're getting their first job and they're setting up their super fund. They're not getting legal advice. They're not getting estate planning advice. They're writing whoever they want in their forms. And a lot of the time they get it wrong, especially like younger people. They might write their siblings, their parents, their friends. Older people might want to skip a generation and go to the grandchildren. None of these people on this side are eligible recipients of the super. And it can be very counterintuitive, especially like a young person who doesn't have a spouse or children. Really, their only option is their legal personal representative. Sometimes if they've got financial dependent or interdependent relationship, but 99% of the time they can only pay it to their legal personal representative, but they will try to put something like this in here. So it's important that you understand who can receive the super and who can't receive it in a BDBN, and check that for your clients. Just rounding out a couple of these definitions, I've got the legislation reference here. It's Section 10 of the SIS Act. So go, if you are ever in doubt about whether someone is eligible, go to the source and make sure that you check it and work through the requirements, okay? But just be aware, the meaning of spouse for SIS dependents is quite broad in terms of either, registered relationships or de facto relationships. For SIS Act purposes, it doesn't include former spouses. Great question about the stepchildren. So again, in Section 10, we've got the meaning of child. It does include stepchildren, but it gets a little bit messy where, let's see if I can think this through. The member, where we're talking about a stepchild of the member who dies, because then the relationship with the parent ends. So like if the surviving, so say I've got my husband and he has a child from he doesn't, but let's say he has a child from a previous relationship, and then we've got our children together, and he leaves me all his super when he dies. Sorry, honey, to pick on you. And so I've then looking at my estate planning, and I've got our two children together, and then my stepchild from him, so his child from a previous relationship. That child actually stops being my stepchild when my husband died, because our relationship ended. So the connection between me and his child from a previous relationship, they're no longer like an official stepchild, as I understand it in the ruling. So it can be a little bit tricky if you want to provide for them directly from a BDBN. Okay. Financial dependent, this is determined on the facts. So question of fact, not defined in the legislation. There's a lot of decisions and AAT decisions, ATO IDs, but it's not super, super clear. There's emphasis on things like regularity and continuity, reliance, and the beneficiary needs to be dependent on the deceased member. So it only goes one way. It doesn't matter if the deceased member was dependent on the super beneficiary. It has to be the beneficiary dependent on the deceased. So again, if you're relying on this, then just make sure you do the deep dive, and I would say document the reasons why you think they're a financial dependent at the date of making the BDBN, but then that whole exercise as a question of fact would need to be reviewed and repeated at the date of death and the date the payment was to be made. Then we've got the interdependency relationship. So Section 10A, close personal relationship. They live together. One of them provides the other with financial support, or one or each of them provides the other with domestic and personal care. And there's more guidance around this too. For some reason they're not living together due to a disability or something, they can still be in an interdependency relationship. So have a look at this regulation. What what a nice number that is, for more guidance. So some examples might be like siblings living together, adult child living with and caring for a parent, or vice versa. So look, to be honest, I'm not a deep expert in interdependency relationships and financial dependency, but I do want to bring this to your attention. And again, this would be an area, if you were actually preparing a BDBN on this basis, to go and do the work, look at all those primary sources and do the analysis. So I just want to emphasize how important the terminology is and how important it is to make sure you use the right terminology and are really complying with who is a death benefit dependent in the SIS Act. So in Munro and Munro, the member made a BDBN. Now, this fellow was himself a lawyer, and in his BDBN, he wrote, I pay 100% of my benefits to the trustee of the deceased estate, of my deceased estate. That was not sufficient. It was an invalid BDBN because he needed to use the exact phrase legal personal representative. So can't go with the vibe. You have to follow this to the letter of the law. Even though they kind of mean the same thing, the letter of the law stands. Okay, so when we are looking at the tax treatment on the super benefits on death, we've got two questions. Firstly, is the recipient of the super benefits a death benefit dependent for tax purposes? So I've just been talking about death benefit dependents for the SIS Act purposes. So we actually have two definitions of the same term, one in the SIS Act and one in the Tax Act. So how they work with each other is, firstly, you can't even pass go. You don't even get off the starting block if you're not a SIS Act death benefit dependent, right? And then they look at, okay, so you've got the super. All right, now what's the tax treatment? Does that make sense? So you look at, are they eligible? And then, okay, now what is the tax treatment in that eligible person's hands? Now, this, I believe, is assessed just before the deceased person died, as to what their relationship with the deceased member was, to be whether they're a death benefit dependent or not. Next, we look at, is that payment being received by the beneficiary as a lump sum, like a wad of one payment cash, or as a pension, like a income stream drip fed out to them? So here I have an amazing table. I can't take credit for this. I've taken it from the book Death After Tax: Essentials for Executors by BNR Partners. So Ian Raspin and Lynn Freshwater have made this amazing resource. They're my go-tos when it comes to tax and deceased estates and tax and dying. So they've put together a really helpful table here, overlaying the two definitions. So it is a different table. So basically, we've got a couple of differences here. So former spouses aren't eligible to receive the super, but they are okay. They're included in tax if they happen to somehow get it. The main real difference is children. So children doesn't matter your age, you're an eligible super death benefit dependent, but the tax is different for you depending on whether you are under 18 or over 18 and financially dependent. So basically, this is my rule of thumb. If the children are under 18, then they will receive the super tax-free as a death benefit dependent for tax purposes. If they're over usually 25, then they will pay tax on it. And then if they're between 18 and 25 and financially dependent on the deceased member, then they are okay and they will be a death benefit dependent for tax purposes too. So it's important. You can't get off the starting blocks unless they are a death benefit dependent for super purposes, and then depends on whether they're receiving it tax-free or not. So people say, there's no death taxes in Australia, but really there is a little exemption to that, which is this whole regime around some people can receive super benefits and life insurance and super tax-free, and others pay tax on it. So that is sort of like our asterisk to no death tax in Australia. Then there's differences depending on whether those tax death benefit dependents are receiving their amount as a lump sum payment or an income stream payment. So basically, everyone can receive their super as a income pension except adult children. Also, if you are a minor child and you receive your income as a pension, that pension must end when you turn 25. So I can just see your question. I'll answer that in it later because it's well, I'll answer that at the end because it will take us a little bit off track about the tax, and I want us to keep our focus. So we actually had a really excellent presentation by Michael Sick a while back that is available in the group about child pensions for super purposes, and we actually compared like testamentary trusts, income streams for children, minor children, and child pensions, and we could dive into how the child pensions work. So that's a really good resource to have a look at. So let's just summarize what we can see in those two tables from BNR partners. Firstly, we need to look at where is the money going, and then if it's going to the death benefit dependent directly, like not to do with the estate, nothing to do with the will, if the BDBN names this person to receive the super directly, then there's a choice of whether it's paid as a lump sum, a child pension, a pension or income stream to a dependent who is not a child, or a reversionary pension, which is usually to a spouse. Or it can go via the BDBN or the trustee discretion to the legal personal representative to be distributed into the will. And then in that case, it comes into the estate and is then distributed pursuant to the will or the rules of intestacy. So it might go pursuant to a gift, it might go into a testamentary trust. If you're using this to the legal personal representative option, it only comes out as a lump sum. You don't have any of those drip feeding options. Okay, more tables from BNR partners. So just to again clarify the tax rate that applies. So we've got our two concessional contributions here, the taxable taxed and the taxable untaxed. So remember that taxable untaxed was the like life insurance type thing, or if this you have that special fund. So, and then the non-concessional contribution is the tax-free. So concessional contribution, back to our very beginning, that's like your pre-tax money. So if your employer pays your super guarantee straight into your super fund, or you like pay it before 30 June and you want to claim your tax deduction, that's this concessional contribution. So that when it comes out, it's tax-free to everyone if you're a tax death benefit dependent. So a tax death benefit dependent. If you are not a death benefit dependent, then you're going to pay the lower of your marginal tax rate, or 15%. With the taxable untaxed, like the life insurance, for instance, that rate is 30%. But actually not very, there's actually a whole, BNR partners have put a hash there, and that's because there's a whole lot of rules attaching to that calculation. It's very complex, which we won't fully get into today. The non-concessional contribution. So this is like money that you have paid tax on, you've earned it, you've paid your tax on it, and you put it like in your savings account or whatever, and then you put it into the super fund. Because you've already paid tax on that, it's tax-free regardless of who it goes to. So the real thing to think about is minors and spouses can pretty much receive any money from the super fund tax-free. It's those adult children or non-dependents, like, a sibling can receive super money, but it has to go to the legal personal representative and then be gifted to that sibling through the will. And then they will trace who received that money. Oh, it went to a sibling. They're not a dependent for tax purposes, so they're going to pay that 15% tax on that amount, for instance. So basically, the tax office does not miss out. They clip the ticket. Okay. So here you got a tax deduction on that money going in. That whole time it's been in the fund, they're waiting to see who's going to receive it. And if it doesn't go to a tax dependent, then they will clip the ticket on the way out and make sure they got their money that they ought to have received at the very beginning when you earned that money. So rest assured, the ATO does not miss out. And that is the reason why we have these rules and why it's so complicated. And then we've got the income stream rules here as well. I won't talk you through all of those. But in that case, like the trustee of the fund pays the tax on behalf of the individual beneficiary when we've got the income stream. So let's have a look at it back to our example where that we had at the very beginning. So this is the same one where you or we put our $25,000 before tax concessional contribution in, and we claimed our tax deduction. And then we also put in our $15,000 from our savings account, and we didn't claim a tax deduction because we'd already paid tax on that. So we've got a member balance of $25,000 representing our concessional contribution, which is classified as a taxable taxed component. And then we've got $15,000 representing our non-concessional contribution, which is a tax-free component. So, and let's say there's a life insurance policy that will pay a benefit of $750,000 within the super fund. This is when we're talking about life insurance, I'm only talking about it owned in the super fund for today's purposes, not owned separate to super. So I die, and I've got my minor children and my spouse who are going to receive this from the super fund. They are death benefit. Well, firstly, they're death benefit dependents for the SIS Act, so they're eligible to receive it. And then secondly, they are death benefit dependents for the Tax Act, so they can receive it tax-free. Yay, amazing, good outcome for everybody. What happens if my children are now grown up? I didn't die. I've still got the same member balance, and my children are grown up. I don't have a spouse. I'm just leaving it straight to my 4 adult children who are over 25. It gets a little bit more complex. In that case, see the black text, my contribution, which was my $25,000 before tax that I paid, claimed the tax deduction on, can go to them. But because it is a taxable tax component, they are going to pay tax on that at 17%. So 15% plus the 2% Medicare levy. My blue amount, the tax-free component, which was, this should be in blue over here, which was my savings money that I'd already paid tax on. I didn't claim a tax deduction for. That's my tax-free component. That can go to my adult children, no tax, because it's already been taxed. Okay, so they get that amount tax-free. Now, my life insurance amount of $750,000 received by the super fund going to dependents who are not tax dependents is my taxable untaxed component. So there will be tax payable on that at 32%, but it's not just a straight calculation. It's taxed, as I understand it, you have to look at how close are you to turning 65 or your last retirement day, and then they do a proportionate calculation back to work out how close you are to retirement. So I don't really know how to calculate that. As I understand it, it's quite complex. So it's not 32% tax on the whole thing. But be aware that there would be some tax on that because it's going to the adult children over 25. Whew, okay, that is the hard stuff. That's the really hard stuff. We've got 10 minutes or so. So I'm just going to explain, why does this all make sense? Or what's the context to this? Okay. This is extraordinarily complex. You as a lawyer will never have to do it. It is not the lawyer's role. I don't even know whose role it is. Perhaps the accountant and the financial advisor. I think maybe the auditor gets involved as well. There's also proportioning rules as well to consider. So for instance, if you had a combination of minors and adult children, you can't be okay, we're going to put the taxable tax component to my minor child who can receive that tax-free, not 17%, and then our tax-free component can go to the adult children. You can't do that. It's if you have a mix, then they get a proportionate share of taxable tax and untaxed. So just be aware of that. But there are planning things that we can do if we get in front of the client in time and look at this, that a good financial advisor will be clued onto this. All the financial advisors watching this, of course, you are in that category and you're already alert to estate planning. But if you've got a client who maybe has a public offer fund and hasn't really thought about any of this, you could introduce them and refer them to a financial advisor who can help them. And your job, the reason I'm telling you about this is so you're alive to the opportunities. So for instance, if you have clients who are between 60 and 67, or they're over 67 and working, you can actually convert some of this taxable taxed component into the blue tax free component by doing a withdrawal and recontribution strategy. So as mentioned earlier, Delene Jacovides did an excellent presentation. Who remembers the green and the red M&Ms? Go watch that if you want to learn about how that works. And hopefully Delene will also explain what I've just explained. So maybe hearing it twice from two different people will help make it make sense if it's kind of a bit fuzzy for you. Other options are, if you do want to do like streaming and to avoid that proportioning rules, you could look at separate super funds, right? So one for the minor beneficiaries, one for the adult beneficiaries, with your concessional and non-concessional contributions split up so that you can stream with different BDBNs. There's also opportunities about planning. Should we be doing this as a lump sum income stream or reversionary pension? And perhaps looking at, if there are no tax death benefit dependents, maybe they need to revisit their life insurance and have that outside of super now to avoid that extra untaxed element. So there's context about all of this. Maybe you'll be recommending it. Maybe the financial advisor will just say, hey, we're in the middle of doing this, and you'll understand the context to it. So just a couple of concepts. So as I said before, the trustee of the super fund can pay the benefits either directly to an individual beneficiary of a member or into the legal personal representative's hands to be distributed under the will. So where there's no BDBN, the trustee decides. Where there is a BDBN, the member decides and tells the trustee what to do. In the instance where the super benefit is going to an individual beneficiary directly, it's bypassing the whole will. The trustee of the fund basically pays the tax on behalf of the beneficiary. So they withhold it from the payment, and then the beneficiary gets the net amount. This is important to know. So when that happens, and like say one of my parents died and they had a BDBN having some super coming directly to me. So I get the net amount, the trustee of the super fund held back the tax and pays it to the tax office on my behalf. That year, say I get an extra $200,000 from my parents' super fund. Thank you. When that happens, that actually gets taxed in my personal tax return for that year. Now, in my tax return, there is a tax offset so that they only make sure I get taxed up to 15% on that, 17% or 15% plus the 2% Medicare levy on that amount, right? So I'm not necessarily like penalized, but there is an impact from a tax perspective on the way that your income is calculated. So my income for that year is like $200,000 higher all of a sudden. And that impacts your Centrelink childcare subsidy amount, which I never really appreciated until I had children who go to childcare, about how frustrating that would be. Like, yes, I did get the windfall gift from my parent, but I'd like to have my cake and eat it too and not lose my childcare subsidy. And then there's also this Division 293 high income earner tax, which it also, that
the super benefit when it's paid directly to the individual is calculated for. So there can be some flow-on effects which do not apply if you pay it to the estate, if you receive it through the legal personal representative. The 2% Medicare levy is also payable on it. So that's one thing to consider when paying it to the individual. I would say the benefit is that you potentially receive it faster because it doesn't have to go through probate and the whole estate administration process. If, however, my parent nominated their legal personal representative and I received their super benefit as part of my share of their estate in their will, two things I'll just mention. Firstly, the legal personal representative will pay the tax on the amount for you, and that amount of super money is not included in my personal tax return, right? I just get it as a lump sum gift, and it's not included. My income is not grossed up, so it would not affect my Centrelink benefits. So in this scenario, I could have my cake and eat it too and keep getting my childcare subsidy, and I don't have to pay the 2% Medicare levy. But, it can be a bit slower. And if you're using a testamentary trust, you have to use a super proceeds trust. So before I just dive into super proceeds trust, that is something to consider about the BDBN directly to the individual or the BDBN to the LPR. And there's a question about when there's a minor who's under 18 and they receive their share, who's it held by? So that will actually depend on whether it's paid to them directly from the fund or to the estate. So as I understand it, the typical practice, it's held on a bare trust, right? The typical practice from most super funds when it's paid from the super fund to the minor is that it goes to the guardian of the minor to hold it on a bare trust for them. But when it's paid through the estate, you could actually, it will depend on how the will's drafted. So it could go to the executor in that case, or if there's a bare trust or any other kind of trust set up for that beneficiary, it could go there. So typically it would go to the executor. So I can't, it's, as you can see, it's telling Facebook users. So I can't see who's asked that question, but I think both answers are correct depending on where it goes. But yes, thank you for asking that. That's a really good point. So a super proceeds trust, super quickly, if you are paying the super into a will that contains a testamentary trust and you want it to go to a testamentary trust, it actually has to go to a super proceeds trust. So the whole point of the super proceeds trust is to make sure that the people who should have received the super tax-free had that money gone to them as a direct individual payment from the super fund will receive the super tax-free even though it's going to them through a testamentary trust. So like what I've got here on the screen is a range of beneficiaries that you would typically see in a normal testamentary trust. So I've got here the green and it's got, siblings, nieces, nephews, all of these extra beneficiaries that you might expect in a testamentary discretionary trust who are not death benefit dependents for tax purposes. So a super proceeds trust is like a narrower range beneficiary testamentary trust. So only the people who are death benefit dependents for tax purposes can be a beneficiary of the super proceeds trust. And what that does is tells the ATO, that super money is going to go into the super proceeds trust. The only people who could possibly benefit are people who satisfy the death benefit dependents definition for tax purposes. So let's pay it tax-free through to that trust. And that is basically how the ATO accepts that if only death benefit dependents for tax purposes could possibly receive. They don't care how the trustee allocates that amongst those beneficiaries. So I've seen this done a couple of ways in practice. This is how I like to do this now under my precedents. It's like an optional separate trust. So like the super benefits will go into the super proceeds trust with the limited beneficiaries, and then the other assets will go into the main testamentary trust with the full range of discretionary beneficiaries if it's needed. So if you think it through practically, it's usually only needed where you've got a couple with a spouse and minor children. Adult children, they're not death benefit dependents, so there's no point, kind of thing. The other way that I've seen it done in practice is as a sub trust of the main trust. So basically, the trustee is holding those super funds only for a smaller class of people, and they have it documented as a sub trust arrangement. And there's pros and cons of each of those. We did have a separate super proceeds trust Facebook Live years ago, probably about 4 or 5 years ago, that you can go and watch as well. Death benefit withdrawals, I'll just mention this. So one other way to convert your taxable component, the money that the non-death benefit dependents for tax purposes will pay tax on, is if you withdraw it from the super fund before the member dies. So if the member is in a position where they can satisfy a condition of release, so like death is imminent or some other condition, they can actually pull it out as a member withdrawal. And once it leaves the super environment, that category of money goes from super to cash. So when we're looking at the tax from an estate perspective, it goes from super benefits just to their cash at bank in their bank account. And there's no tax on them getting it out of the super fund. And then when they die, if they want to leave it to non-death benefit dependents like adult children, it's cash. There's no tax attached to that, and it can go to those adult children tax-free. So that is a strategy that you might need to be involved in, and that is definitely requires a lot of collaboration between the financial advisor and the lawyer. And it is quite risky. There's issues here, particularly if the member does not have capacity, about whether you can even do it from an enduring power of attorney, who the trustee of the fund is, especially if it's a self-managed super fund. If they have lost capacity, then you might need to restructure the ownership, the trusteeship and compliance of the fund really quickly as well. And there can also be processing delays, especially if it's a public offer fund. So there's been quite a few recent publications released by the ATO about if this happens, then it's a death benefit payment, which is a super payment and the tax applies. And other times it's a member benefit and the super doesn't apply. So it's complex. You really need to know what you're doing. Again, just a little plug for the Child Pension Facebook Live by Michael Sick, where we compare the two, which will help give a bit more context to those income stream payments. And I'm going to wrap it up now because we've gone right on the top of the hour. I think I've answered everyone's questions. Thank you so much for joining me today, for asking your questions. Happy to keep this conversation going. Part 2 is going to really focus on the estate planning part. So we're going to look at binding nominations, other estate planning strategies, who to nominate, the whole thing. Okay, so this was really just laying the foundation for part 2, which will be on the 13th of June, 2024. And next month, we've got David Lunn presenting on estate planning strategies for illiquid assets and SMSFs on the 11th of April. So hopefully today is a good foundation as well, just to really set that scene. So thank you so much for joining me, and I'll see you next month.